Hello everyone, and welcome to Finance to JCL. Okay, today, Bank OZK, company that I reviewed last summer. It's had a really good run recently, so I'm going to see what the valuation is like and share my thoughts with you. Ticker symbol is OZK if you want to try and have a look at details yourself. Very briefly, before we start, the usual disclaimers apply in that your capital's at risk when investing, and this is not investment advice, so you should make your own decisions and take financial advice. I directly own shares in Bank OZK. It's the largest holding in my portfolio in terms of individual stocks. So we'll start off by looking at the revenue and earnings profile to determine the momentum and trajectory behind the business. So I'm over at morningstar.com on the Bank OZK page, and you can see that the revenue here across the top has gone from 194 million in 2010, consistently increasing each year, and it's just got to around about $1 billion. So we're looking at a 5x or so in revenue across a period of about 10 years. The net income has been similarly growing, $64 million in 2010, hovering up plus or minus a bit around 100 billion for a few years, but then 2015 182, 2016 270, and then for 2017 to 2019 is in that kind of 420 million region. It has dropped a bit trailing 12 months, and that's not surprising given what's been happening in the world, but it's still a healthy $272 million. Earnings per share generally much higher than it has been in the past. That has grown. Let's now have a look at the net margin. That has consistently been 30s, even in the 40s%. Just apart from the trailing 12 months, it's just dipped below 30% for the first time in 10 years at 28, which is still a very healthy net margin. So the earnings look good, the margins look good, and the revenue is increasing. So next up, I'm going to look at the book value and dividends. Now, I usually look at free cash flow here, but this is a bank financial company. Book value is a better measure to use for these organisations. So let's have a look at how that's been growing over time, because it is a good proxy for the value of the bank. I'm back on Morningstar looking at the book value per share. You can see that from 2011 it was just $5.90 per share. Every year has increased. The book value per share is now $32.37 for the trailing 12 months. That's a massive increase from around about 6 to around about 32. So that's over a 5x in book value in 10 years. Absolutely incredible. There's about a 20% or so increase per year in the book value. We're just going to have a look at the dividend. So that has also consistently increased every year from 2010 to the most recent period, from 15 cents per share, moving all up to $1.05 for the most recent period. So again, that's massively increased. That's what, 6 to 7x over that period of time. And the payout ratio is 50% at the moment, pretty much bang on 50. So there is room to increase, but actually the earnings per share did dip in the last 12 months. If it gets back to its previous levels, the payout ratio might only be in the sort of 20s. And if it's in the mid-20s, then there's a hell of a lot more room to increase. Now, jumping over to Yahoo Finance, you can see that the trailing dividend yield is 2.77%, and the forward is about 2.8%. Next up is the ability of the company to survive. I do like to have a look at Simply Wall Street for some of this information. It gets a really good kind of graphical representation of company information. So if that's the kind of thing you like, I'll definitely recommend signing up to them. I found it a really useful resource. There's a substantial difference, much higher equity than debt. So that's it. You've got a good ratio there. Then look at the balance sheet. The debt is a very small number. Cash and short-term investments is much higher than that. And the debt's really an insignificant number in relation to the overall balance sheet. And then just dropping over to the Morningstar site, the debt to equity number actually used to be much higher. It was over 1 back in 2010. And it's been dropping ever since, although a very small increase in the last couple of years. We're at 0.26, which is a very acceptable figure from my perspective. So industry and moat. Now, me, Bank OZK has a very strong moat. They seem to be very good at the kind of loans and business that they write. The way they operate is that they don't take these kind of really high risk, high reward type things that other companies will go for, which might mean they underperform other organizations slightly during kind of rampant economic growth times. But in the tougher times, they actually outperform their competition because there's a lot less downside. They have a lot less kind of bad loans, bad debt. The management next of all, so there's two elements to this. One is how well the management grows the company, uses its resources, and the second is kind of how they're involved, what their experience is. The boss, George Gleeson, 42 years he's been in post, so that is incredible. The amount of experience this guy has is absolutely unsurpassable. I'd say he knows the company inside out, gets the market inside out, absolutely brilliant. And if we have a look at the situation here, he appears to own decent chunk of the company. $200 million of his net worth is tied up in there. And so, yeah, individual insiders do own around about 5.7%. So most of that is down to him. But he's got skin in the game. He knows the company inside out. That is absolutely a good thing. Now, our friends back at Morningstar will have a look at the return on equity. The return on equity figures have always been, apart from the last period, in double figures. We've dropped down to about 6.59%, which is not as high as I usually like it, and it's certainly been lower than the company has had historically. I'd expect that to kind of perk up again once we're past the current kind of health issues and difficulties in the market. So price and value next of all. So sometimes on these finance companies, a bit of a quick win with regards to the price to book ratio. And if that's under 1, it's a really big signal that it could be an undervalued organisation. Now we've seen that the book value per share is 32.37. If we look at Yahoo, actually the share price is almost 39. It's 38.92. So the price to book is 1.18. So it is a little bit over 1. But if you look at the trailing P17, which is still a respectable price to earnings ratio given a lot of the stuff that's in the market, and the forward P is actually only 12, which is incredibly attractive. And if we have a look at the chart and have a look at what's been going on, in the last 5 years, this was topping out at over 50. We're looking at 55 back in 2017. And it's kind of been a little bit up and down. And then we get into 2018, it drops all the way down to 22, starts coming back up again to about 30. Pandemic, and then it's all the way down at 15. Now, I wish I knew about this company when it's at 15, because I may have backed up the truck and loaded up at that point. I have bought 3 tranches, all in the 20s at various points, so it's looking quite good. But there's been a really good recovery here. In the last couple of months, it's gone from kind of in that 20s region all the way up to 39, almost straight up there by the looks of it. So to levels not seen since in the second half of 2018. I guess the question is, how much can that continue? And is there still some value in this as a purchase? So that's what we want to find out. So I guess what's the story and the Peter Lynch classification? So with the Peter Lynch classification, I guess this is quite unusual when it fits between huge categories. So it's partly a stalwart for me, which is a company that's growing at a decent rate, but also pays a dividend and has been around for a while. But actually, the historic growth rate, if you're going at 20% a year, that is almost at the kind of fast grower stage. So it's kind of between fast grower and stalwart. So it's fits in there. Well, I guess the story behind it really is that they're good at what they do. They've got a really experienced management team. They've grown absolutely outstandingly in the last 10 years, actually before that as well. Okay. So we're going to have a look at the key bit you've all been waiting for, which is the valuation, or my assessment of the intrinsic value. And we'll compare that to the price to see what the difference is. I'd just like to give a shout out to my Patreon VIP supporter. If you'd like to have a bit more access to me so we can bounce some ideas around, what have you, then you're absolutely welcome to join in at the Patreon VIP Supporter Club. So valuation, now before I get into the detail of this, I'm just going to have a look at some of the information around what analysts think is going to happen, just to get a bit of a benchmark. So I'm having a look at the Yahoo Finance Analyst tab. And the consensus, first of all, seems to be hold, and there's a few saying buy. 7 out of 10, 70% are saying hold. Now, that doesn't necessarily mean that's correct. It's just an indication. If they're all saying sell and you're saying buy, you need to just double check that you're not missing something, for example. You can see here, next 5 years, they're saying 12% earnings growth per annum. I do like to look at some other sources, so you can see here that the next few years they're looking at 13.3% earnings growth. And that's from 9 analysts, so a similar spread to the Yahoo one. My calculations are around their book value, which isn't quite the same earnings, but the book value is a good proxy for the value of the company. My calculation is that over the last 10 years, it's grown by between 20 to 21% a year as a compound annual growth rate. Now, given the kind of finance people estimate is a bit lower, we saw 12 and 13% there, I'm just going to pair my 20% historic evidence back to 15. That feels like a prudent thing to do. And the discount rate I'm going to use is 10%, because that is the minimum I want for stock picking, because if it's anything particularly lower than that now, you can get that from an index probably over a long period of time. So book value 30 to 37. I'm growing that book value by 15% a year for 10 years. I'm discounting this at 10%. So that gives an intrinsic value of about $57 versus a price of $39. So there's a gap there, and that's at a discount, inverted commas, or a margin of safety of 32%, about a third. But if you look at the other way, the upside from the current price is 50%. So if the stock were trading what I think is actually going to be its worth, based on what's happened in the past and what's going to happen in the future, most importantly, then I think it should be trading at $57 for me to get a 10% return on it. So there is 50% upside to get to that still, even though it's had a really good run recently. And what I always like to do with this is just spot checking it's another source to make sure I'm not going too mental on my calculations. If I'm totally off, then I just double check it to make sure I'm happy with the logic. Now you've got here something that says for Simply Wall Street a current price 39 and their fair value is 61.57, so they're saying it's about 37% undervalued. So we've come to a relatively similar conclusion. So that's my opinion on what it could be worth. Be really interested to hear, first of all, if Bank OZK or OZK, depending on where you're from, if they are in your portfolio, and then what you believe the intrinsic value is worth. And I guess are you going to sell out at that price, or is it a really long-term hold so you can just tick in that dividend over a period of time? So yeah, please do leave some comments below. It'd be really interested to hear. And if you do like this kind of format, if you can smash that like button, that would be cool, because it helps share the video around a few different people then. So thanks very much for joining me on that one. That's Bank OZK. And if you've got any companies you'd like me to review for this kind of analysis, please do drop them in the comments below. So thanks a lot for joining me, and I look forward to catching you on the next one.